Welcome to Crash Concepts, where the economy, energy, and the environment are explored. Up next, fresh ideas and insights into the factors that are driving the world and shaping your future. Presenting information you can't afford to live without, here's Chris Martenson.
Hello, and welcome to another ChrisMartenson.com podcast. I'm your host, Chris Martenson, and today we welcome a very special guest, Dr. Marc Faber. Dr. Faber was born in Zurich, Switzerland, and now lives in Thailand, and he has offices in Hong Kong. Dr. Faber publishes a very widely read and excellent monthly investment newsletter, the Gloom, Boom, and Doom Report, which highlights unusual investment opportunities, and is the author of several books, including Tomorrow's Gold, Asia's Age of Discovery, published in 2002, right at the beginning of the Age of Discovery there. Just fantastic timing. And speaking of timing, in 1987, he warned his clients to cash out before Black Monday on Wall Street. He made them handsome profits by forecasting the burst of the Japanese bubble in 1990, correctly predicted the collapse in U.S. gaming stocks in 93, and he's just been ahead of the curve every step of the way. His company, Marc Faber Limited, acts as an investment advisor, concentrating on value investments with tremendous upside, often based on contrarian investment philosophies. He also invests and acts as a fund manager to private wealthy clients, and was a former managing director of Drexel Burnham Lambert. Welcome, Marc.
Thank you.
You know, one of the criticisms of an empire is that, almost by definition, it lacks the ability to see itself clearly. I see you as having the most essential characteristics required to shed light on the United States. You're a deeply invested insider with an outsider's perspective. But more than that, you've demonstrated an incredible ability to think and perceive independently, to see where others are caught up in dangerously unprofitable groupthink. So I want to begin at the center of this story, the United States, before moving out to the rest of the world. And in the very center of the U.S. lies the Federal Reserve itself. The Fed's been expanding its balance sheet by some $1.5 trillion with a T dollars since the crisis began, and are now expanding it by a further $75 billion a month for the next 6 to 7 months. So what are your views on these actions? Are they necessary, disruptive, ultimately more toxic than helpful, or something else?
Well, basically, first of all, thank you for having me on your show. But secondly, I think that the government's intervention into the free market created the problems in the first place, and we certainly have to view the Federal Reserve as having intervened into the free markets by keeping interest rates artificially low for far too long between 2000 and 2007. So their intervention at the present time is actually nothing new. It's just larger in terms of scale. And if you go back to the Federal Reserve, starting with the early 80s, each intervention, whether it was flooding the system with liquidity to save the SNL institutions, or the Save Mexico in the tequila crisis, or LTCM in 1998, and so forth. Each intervention became larger and larger and created more misallocation of capital, and I think this will also be the case today.
So these interventions, we've just gotten further and further off the track. So you would say that today's interventions, I mean, are these just par for the course? It's just a continuation of a trend that began in the 80s under Greenspan, or do you see these?
Yes, I think the Federal Reserve has openly admitted and written on several occasions that they can't identify bubbles, but if bubbles burst, they can intervene with extraordinary monetary measures to support asset markets to prevent essentially a deflationary recession from happening. And that leads to very asymmetrical monetary policy. In other words, you let bubbles happen, like the housing bubble, and you have to wonder what the Federal Reserve was thinking about home prices going up so much, and about credit between 2000 and 2007 expanding at 5 times the rate of nominal GDP. They also let the NASDAQ bubble happen. They couldn't see that it was a bubble when NASDAQ stocks sold at 80 times earnings. They were talking about the huge productivity improvements and so forth and so on. So if there was one institution in the U.S. that consistently and repeatedly messed up everything, the Federal Reserve is that institution.
So they lie at the center of all of this, in my mind as well.
To a large extent, yes. I'm not saying that everything is due to Federal Reserve policies, because even under a gold standard, you could have a bubble. Say in the 19th century, when there were the gold discoveries in the Midwest and in California, you had boom towns. And when canals were built, there were booms, same for railroads and so forth. But usually, under a gold standard, you have a bubble in one sector of the economy, but you don't have it across the board globally. And that's really what the Federal Reserve has done over the last couple of years.
Well, so they've exported bubbles, and let's be fair. I think the ECB and other major central banks have gone along with the program.
Correct. I mean, I'm not singling out the Federal Reserve as the only central bank that prints money, but certainly they are the leader. Let's say they are the most aggressive in terms of expansionary monetary policies compared to others, because, say, in Indonesia, if you print money, then the currency collapses, then import prices go up, and you have an automatic, essentially, adjustment. This hasn't really taken place in the United States.
Right. So, there's one view then that says the Federal Reserve can't see bubbles. That's the story they like to put out. But there's another story that might go like this, which says the Federal Reserve is a serial bubble blower. They actually need bubbles. They know exactly what they're doing. And now we could look at their purchase of assets as just an attempt to keep assets inflated.
But to be fair to the Federal Reserve, I have to say that this bubble blowing is not just the intention of the Federal Reserve, but actually Wall Street was also encouraging bubbles, because remember in 2001, both Mr. Krugman and Timko was arguing that the housing bubble would actually help the U.S. economy, when in fact thereafter the housing bubble destroyed the U.S. economy. And again in 2009, Mr. Krugman wrote that another bubble would be desirable at the present time, and the consequences of which one could deal at a later stage. So actually, the Federal Reserve is not the only one that is guilty of easy monetary policies. Everybody enjoyed it because everybody was minting money during the bull market in equities and in bonds.
Well, I want to ask you then, because you've got the perspective on this that perhaps few have. My grandfather actually served on the New York Federal Reserve Board under Paul Volcker at one time. And way back when, and I can guarantee you, if my grandfather were alive today, he would not recognize the decisions that are being made or how the Fed is operating. He came from a very solid state banking background, and so I'm wondering, am I just romanticizing? Was the Fed engaged in the same policies back then as they are now, or did something shift fundamentally over the past 10 or 20 years?
Well, I think, to be fair, the Federal Reserve, after its foundation in 1913, has essentially always pursued relatively expansionary monetary policies, with one exception that stands out, and that was the period under Paul Volcker, 1979-1980, when he pushed the discount rate to over 20%. A very courageous move, I may add. But in general, if you look at the price level in the U.S. in 1900 compared to 1800, and you look at real per capita increases between 1800 and 1900, then I have to say that the economic expansion under a gold standard, essentially in the 19th century, was stronger than in the 20th century when the Fed was in existence. And what happened is, in the 20th century, the price level, as you well know, and as everybody knows, has gone up dramatically in terms of how much it costs you to fill the tank of your car, how much a movie ticket costs, how much a pound of bread costs, and so forth and so on. And so, really, the policies of the Federal Reserve have always been inflationary. And I would say every central bank that essentially has the control over the quantity of money will in the long run pursue inflationary policies. Maybe temporary, occasionally they tighten monetary policies. But actually in the US, we didn't have tight monetary policies now for 10, 20 years.
Mm-hmm. And the Fed, I think, is not quite as firm on this as the Bank of England. Bank of England has a stated target, 2% inflation. So they've put it right out on the table, said, we're going for it. We want inflation this much, not more, not less. And I think that the Fed
but do you understand? It's very difficult to define inflation. The Federal Reserve essentially targets core inflation. Core inflation has nothing to do with your cost of living increases. And as you know, the basket of goods and services that are used to measure inflation can be weighted in such a way that things that go up a lot, like healthcare costs, insurance premiums, energy, is disregarded entirely. And other items where prices are deflating, like a T-shirt, are overweighted.
Yeah, I'm really feeling...
I have a large readership for my newsletter and website, and I asked to please send me an email if anyone has the impression that his cost of living increases were less than 5% per annum. So far, I haven't received a single email.
I don't think you'd get any emails from anybody who's listening to this either. And inflation varies. It depends on your circumstance. So if you have a child about to enter or in college...
Absolutely. Every household has a different inflation rate. All I can say is maybe I buy at the wrong places and I travel in the wrong airplanes and stay in the wrong hotels, but my costs of living are going up every year.
Yeah, they absolutely are, and we should also note that the official measure of inflation does not include taxes. The entire cost of government
is absolutely, and in that and hidden taxes, namely fees that you pay to the government. And in any event, I don't believe that any one of your listeners will have a wife that tells him, "Listen, you can give me less household money because prices are down." That I don't believe.
We'll try that sometime. I think you're right. So we have the theme then is that we actually have a lot of inflation. I mean, if you look at a basket, let's take the entire continuous commodity index. In 2002 until today, it's been going up over double digits on a per annum basis.
Yes, of course. And also a symptom of inflation is when the currency weakens. And the symptom of inflation is the explosion in international reserves, which have grown from $1 trillion in 1997 to now over $9 trillion. These are all symptoms of inflation. And we have to define inflation as an increase in credit and in the quantity of money. And everything else are symptoms. And inflation can manifest itself in a global economy in Vietnam, where prices are going up at, say, 12 to 15% annual rate. In India, in China, where prices are going up by at least 10% per annum. So when you print in the U.S., it doesn't necessarily have to inflate the housing market. And that shows the futility of U.S. monetary policies. U.S. monetary policies were designed by Bernanke basically to lift home prices. But this hasn't gone up. Other things have been inflating, namely like oil and food prices, which then hurt the consumer when the policies are designed to actually help the consumer.
Well, is there...
I mean, Mr. Bernanke, I have to say it, and I hate to essentially be outspoken in this way because I think he's quite a decent fellow, but he's just ignorant of economics, and he's a victim of his ill-conceived monetary theories.
So he's running a big experiment. And how do you see this experiment playing out? So from my perspective, I have, the inflation-deflation debate, it rages. And I've written recently that we should, and I'm italicizing that word as I speak it, we should be in deflation, but we're not.
We should have been in deflation after 1980 because the Kondratiev peaked out in 1980 or in the mid-70s to the 80s. And then we have a downward wave in commodity prices and declining interest rates. That is the time we should have had deflation. But now that commodity prices are turning up, it's more likely that we are in a very high inflationary environment. And the reason I have this debate with the deflationists is not so much that they believe in deflation and that I believe in inflation, but their conclusion to buy U.S. government bonds in a deflationary environment is, of course, a disastrous recommendation, because if you really have the credit collapse the deflationists are arguing about, then obviously tax revenues will collapse and the fiscal deficit will go to the moon. I mean, Tim Geithner just signed the Treasury report about the budget deficit, about the financing of the U.S. for 2010. The deficit was not $1.4 trillion, but $2 trillion, signed by him. And so the government debt goes up and up and up, and then the interest payments on the government do go up, and the quality of the government debt goes down. And so eventually you have a junk bond in the U.S. I believe the U.S. government bonds are junk already today, but as long as you have rating agencies that are dreaming and publishing reports that are completely useless, people still buy the government bonds in the U.S.
Well, let me play slight devil's advocate on this. So right now the Federal Reserve is buying about 100% of all the new Treasury issuance for the next maybe 6-7 months.
Yes.
Can't they just keep doing that forever? I mean, what would...
They can keep doing that forever, and obviously then the currency depreciates over time, and interest rates go up over time, but they can do it for a very long time, and at some stage you go into a hyperinflation environment. I'm not saying that hyperinflation is around the corner, but with this policy, you're moving a step closer to a danger zone.
So they're increasing the risk. We can't be certain, but obviously the risk is now higher than it was
Much
2 years
higher.
ago.
I would also say that the financial position of the U.S. today, if you look at the unfunded liabilities, if you look at the external liabilities, and so forth and so on, is of course much, much worse than 10, 15, or 20 years ago.
Well, they actually, I think if we did an accrual basis, we've been adding $3-4 trillion a year to the overall
absolutely
negative position on that. It's
the government debt, including Fannie Mae and Freddie Mac, by the way, another intervention by the government into the free market that had disastrous consequences. I mean, basically, everything the government has touched in the U.S. has been a complete failure, from the post office to monetary policies, to fiscal policies. You want to have a consistent track record of complete failures. Look at the U.S. government.
Now tell us how you really feel.
I beg your pardon?
I said, tell us how you really feel about that one.
Well, I think it's a wonderful experience because it shows that the private sector tends to do things better. They don't do it perfectly well, but at least in the private sector, when something goes wrong, then an institution or a corporation goes bankrupt, and then the system is cleaned. The worst part of government intervention is that they don't let their own failures appear, and instead of letting big companies go bust and clean the system, they go and support them. And this is unfair to the strong competitors, because capitalism is all about the survival of the fittest and about people who make or take wrong decisions being punished through losses.
I agree with all of that, and I think that it's corrosive to the markets because participants like myself start to look at it and say, this is not free, it's not fair, it's, how is it possible that the bondholders of Citi didn't take a single penny of losses? This just doesn't feel right. And worse, we don't, investing is about taking your best shot, doing due diligence, figuring out the fundamentals. But we're all speculators if we have to sort of guess what the government's going to do next, who they're going to bail out, how much money the Fed's going to throw in, because those are unknowable. You can do all the due diligence you want, but you can't predict any of that.
Well, in particular, it's unfair because there is a revolving door between some financial institutions and the government. So your access to information is, of course, much, much worse than the access of information of the big financial institutions. And so you have a marketplace that is completely unfair.
Right. So let me get to the punchline on this. So the way that I've been analyzing this myself, it sounds like you might agree, is that the unfunded liabilities plus the current fiscal structure, the deficit structure, how much mandatory spending is already baked in the cake compared to total economic output, which is what tax revenues come in from. There's this enormous mismatch between revenues and expenditures, right? How does this resolve itself?
Well, I would imagine that the resolution will be more money printing because that's the easiest thing to do. And over time, money printing leads to a huge increase in wealth and income inequality, whereby the smart operators, the rich people, the well-connected people can make a lot of money. It's like in war times. You have the parasites that can make a hell of a lot of money in war times, but it impoverishes essentially the population, and the same happens when you print money. And then, you move into an environment where there is a very high distrust between the population and the government. There's a state within the state, and that's the government, and the people are unhappy, and then when everything fails through money printing, usually the government has to look for someone to blame for the unpleasant economic realities. And then frequently they either blame a minority, like in Africa, the Indians, or in Indonesia, the Chinese, and so forth. And when everything fails, these countries tend to go to war. And the U.S. is already at war, because in war times, it's not important to win the war. Whether you win or you lose, a lot of people make a lot of money out of wartime.
Well, that concludes part one of this interview, and I really want to thank Dr. Marc Faber for taking the time to share his unique, outsider-in perspective, his years and years of incredible forecasting abilities and experience with us, and bringing that to this conversation. The second part of this interview, which is available to our enrolled members, Marc and I are going to delve into his specific thoughts on how this economic dysfunction is going to play out, as well as his prognosis for 2011. If you're not yet an enrolled member, visit chrismartenson.com to enroll. Please join us there for part two of our conversation with this amazing individual.
This concludes this podcast by Chris Martenson. To gain further insight into where things stand today and what might happen tomorrow, please visit chrismartenson.com. That's CHRISMARTENSON.com. Please join Chris Martenson next time to continue your journey toward awareness, understanding, and action.